All right, so today we want to look at another important standard, which is IAS 12. I wanted to say that there is this book I'll share with you. I think I've not shared it. There is also an advanced one for corporate reporting. I will share some of these books with you in case you don't have it on the Telegram page today. Yeah. All right, so we want to look at another important standard, which is International Accounting Standard 12, which deals with income taxes. Now, if you take all the professional exams that you have to write, like the accountancy exams, so those that are in Ghana, the ICAG, the global one, the ACCA, those in Nigeria, the ICAG, another part of the world, most of these accountancy exams, professional accountancy exams, have a course in it. They have a course in it which we mostly call taxation. So there is a specific course on taxation. So if you are doing ACCA, there is this, you learn the taxation of I think the UK system or the UK economy, right? So there is a course on taxation which deals with the comprehensive form of taxation, like even those in Ghana, if you want to become a chartered, I think, tax officer or something like that, you need to write CIT, Chartered Institute of Taxation. It's a whole full package on taxation. Please, the standard IAS 12 is not about those taxes, it's not about that course. The standard IAS 12 focus on only one kind of course, one kind of tax. One kind of tax. And this form of tax is income tax. And even that, there are things that we will not do under the standard IAS 12 because there is a specific course designated to treat or to focus on, all other comprehensive discussion on taxations. So if you pick the full course, like you have to look at the tax laws in your various jurisdictions. You have to look at how to compute for, I think, those capital tax, gift tax, all forms of tax are all discussed in the full course. So when you pick IAS 12 just focus on just one particular type of tax, and you can deduce that from the topic or the name, which is income taxes. So please bear that in mind, that income taxes does not deal with all types of taxes, just only an aspect of the income tax, and even that's not all types of income taxes. So which kind of income taxes does IAS 12 talks about? Before we dive into the whole the objectives, the scope, and then the other things, let's quickly look at something. If you have let's assume this is our comprehensive income statement, and then, like I was saying, we have your revenue here, we have your cost of sale, then you get your gross profits. After you get your gross profit per the IFRS 18 formats, the next thing to do is your operating expenses. So we have to take care of our operating expenses. And then, so this has to do with admin costs. You get admin costs. This will be the last thing we'll be doing. We have to get what we call selling and distribution costs. Then if you less these two costs, so you can get a figure here. If you less these two costs, we get our operating profit. So here, this is where we add finance income. So once we've gotten our operating profit over here, you add finance income. So this way, instead of adding other income to our gross profit, like we know, we don't do that again. We add what we call finance income. Can be any form of income, that the rent receivables and all other types of income is added to our operating profit, and we less finance cost. So finance cost has to do with all forms of all forms of interest on loan, interest on finance lease, interest on long-term liability debentures. We call them finance costs. So you do that over here. So you add finance income to your operating profit, and then you less finance costs from your operating profit, and you get what we call profits before tax. Now this, after you've gotten your profit before tax, the next thing you have to take care of is your tax expense. This is where you have to resort to IAS 12 to determine your tax expense for the period, right? Now, your tax expense, according to IAS 12, always comprises of two things. We have what we call the current tax, and the deferred tax. So these two taxes come together to form your tax expenses for the period. And how do you get this value? How do you get this figure? That is why we are here today. So today's discussion is on how to get our current tax for the period, is on how to get our deferred tax for the period, as well as when we go to the statement of financial position, there is an aspect of the current tax and the deferred tax that must be in the statement of financial position. So how do we determine all those figures? How do we account for them? How do we even present them? And which aspects? And we will solve some questions from the ICAG past questions. We will solve some questions to augment our understanding. So that's why we are here. How do we get this tax expense? So remember that, as you can see, the last time we deal with cost of sale. So we are picking every item one by one. So by the time we are done with all the standards, we would have covered everything, and we would have been, fully prepared to prepare the full financial statements. So starting from the income statement, that's why we are picking the standards one by one. And you can see that the items in the income statement, most of them is a particular standard. So by the time we are done with all these standards, we should be able to prepare a full comprehensive income statement, statement of changes in equity, and then statement of financial position, as well as the cash flow statement. All right. So like I've established, IAS 12 talks about two types of taxes. That's why we call it income taxes, not income tax as taxes. That means it's more than one tax that we are looking at over here. All right. So we can look at the scope of the standard. The scope has to do with all forms of taxes. The income statement talks about all forms of income taxes, including international and domestic income taxes, and sometimes withholding taxes. Yeah, that's the scope. So the scope does not go beyond this. So it talks about both international and domestic income taxes, right? Okay, but like I indicated earlier on, there are certain things that we are going to do, and you won't get it in the standard, because there's a full package of a course on taxation. And remember, the objective of the standard is to prescribe the accounting treatment for income tax. All right, like I was saying, IAS 12 has two types of taxes that will be dealt with. So two types of taxes. So two types of taxes. We have what we call the current tax. We have what we call the deferred tax. So once we are done with this, account, how do we derive, how do we get this tax? Once we are done with these two, we call the standard, or we call it for a day, because the whole standard is about these two type of tax. Okay, without wasting time, let's pick the first one, which has to do with current tax. Current tax. Current tax. What is current tax? When we talk about current tax over here, we are making reference to is a tax, it's an income tax, sorry, so it's not just a tax, but income tax that is payable or recoverable with regards or in respect of taxable profits or tax loss. All right, so when we talk about current tax, is a tax or amount of income tax that is payable or recoverable in respect of our taxable profits. So there is something we call taxable profit. So if we want to present this in an algebraic form, we are saying that current tax should be equal to our taxable profits multiplying our tax rate. But there are certain times, in the lives of a business, it's not always the case that you're going to get a profit. Okay, so when you get a loss, so this is going to be tax. If you get a loss for the period, it's going to be tax loss. Then we multiply it by the rates, but that one, there is a treatment for it. Now, please pay attention to what we are about doing, because it's the foundation for the whole taxation principle. If you want to get the principles of IAS 12, it's about what we are about doing. The explanation of the meaning of current tax is the foundation and is the key principle to understanding IAS 12. Now, we said when we talk about current tax, we are saying that it's the income tax payable. So let's underline the word payable. Let's first talk about what is payable over here. So the word in accounting, anytime we say payable, that means it's not yet paid. It's not yet paid. That means it's something we are owing, which we will pay for in the future. So always the amount of tax we see in the income statement of companies are provisions. Please put it down. I'm explaining this, then I said it's the basis. They are provisions. So for instance, let's come to our practice sheet, and then let me establish something. So we are now dealing with IAS 12. So let me put it at the top. You can blend all this one to make it that this is IAS 12. Okay, so for instance, let's assume we are in 2023. We have 2024, and then this is our current period, 2025, right? And then we are supposed to pay, current tax over here. What companies do is that what we see in the income statement of companies is that they make provisions for the current tax. So that is not the actual tax they are paying for the period. They make provision. That is why we call it payable. As at that day that they are preparing the account, that tax in the income statement has not been paid. It's payable. It's a provision because of something. You will come there. I don't want to jump. Because the tax the company has determined, and when the tax authorities in that country come to audit their financial statement, the tax they have included in the income statement and what the tax authorities will derive or will determine there is likely to be a difference. There is likely to be a difference between the tax the company has computed for the period and the tax authorities have computed for the period. There is likely to be a difference. So what the companies mostly include in their income statement is a provision. So let's say that in the year 2023, the tax they have computed is $100. It's $100. So here is the current tax they have included in their income statement. But this tax is not the final tax they have paid. This is a provision based on their taxable profit. Their taxable profit. So this current tax for the period is based on the taxable profit for that period. Once the current tax is taxable profit, if it's a tax loss, that wouldn't be a current tax again. We will call it a tax credit. I'll come there. So the current tax is determined based on the company's means of determining their taxable profits. That is where they derive this $100 as a tax for the current period. Now when we come to 2024, by then the tax authorities in that country would have come to audit the financial statement of the company. And then they will now say that based on this our audit, you are supposed to pay a tax of $120. Look, this is what you provided for in your financial statement, but the actual payment is always done when the tax authorities have come to audit the financial statement of the company. So why all these plenty talks? I'm saying that a current tax is an income tax that is payable. It's always a future consequence. If I use future consequence, I may bring a lot of another complication when we come to deferred tax, because deferred tax is the one having future consequences. Okay, so payable, it means we have not paid now, but it's something you're going to pay for it probably in the next year. Yeah, in the next year. That's differentiated from deferred tax. So payable. So it's always a provision that is made in the income statement now for the actual payment to be done in the following period based on what the tax authorities, the tax regulations in your country, have come out with for that period. So that is why it's payable. Please, how to compute for current tax in your major questions depends on this principle, this payable thing. All right. Okay, so now let's talk about recoverable. Let's talk about recoverable. Since we understand payable. Please, any question on payable? Any question on payable? Okay. Now let's look at recoverable. Recoverable. It's not always the case that a company will make a profit. It's not always the case that a company will make a profit for the period. Anytime a company makes losses, okay, let me go to my practice sheet again. Assuming that we've paid for 2025 2023 we've paid for our tax 100. 2024 we paid for it. 2025. So 2024 there will be another provision over here. So let's say the provision we made here is 150, but the actual payment will be done here. The actual payment, let's say when we paid when the tax authorities came, they gave us the tax we are supposed to pay is 110. Sorry, it's 110. Then in 2025 we will make another provision. Let's say we are now making provision of 200. Then when you go to 2026, we also can pay based on the tax authority. You now can pay the actual tax. Okay, that is the payable aspects we spoke about earlier. Right, now we are looking at recoverable. Let's assume that we've paid all these taxes because there was a taxable profit for the period. But in 2026, we are making a tax loss. Anytime the company makes a loss, whatever you determine as your taxable profit is not, we don't call it taxable profit again, we call it tax loss. So when you charge your rate on it, what you get is not called current tax again. We call it tax credit. Tax credit. Now a company is only giving tax credits when it is probable that this tax can be used to offset the tax we have already paid in a previous period. So there is a condition for you to recognize a tax credit. The fact that you are getting a tax loss doesn't mean you are automatically, qualified to recognize tax credits. You can only recognize tax credits when it's possible that that tax loss you have made for the period can be used to offset the previous taxes you've paid. What is all this plenty talk? Let's use figures. Assuming that we've paid all these taxes, the actual tax we have paid is 120 and 110. And here we are making a loss and our tax credit is 50. Is it possible that you can go back to offset the 50? You can reduce your 50 from this 110. Is it possible? Is it something that is allowed by your countries or tax laws? If that is the case, then this 50 here will be treated as a tax credit in the current period. In other words, we call it a current tax assets or tax assets, but the actual word or the correct word is what we call tax credit. So here you are recovering your tax. You see, it's a means of you recovering your tax loss, your tax you've already paid in the current period. So previously you make a taxable profit, you made a profit, so you pay tax on it. Now you are making a loss, so you are not paying tax, but you are going to offset the previous tax you've paid. It doesn't mean you go back because our income statement does not allow that we go back. We can only go and effect these changes in the statement of changes in equity. So in a nutshell, it's not always the case that we are supposed to pay tax. Be careful. Sometimes when we end up getting a loss for the period, we are supposed to, when we end up getting a loss for the period, we can go ahead and get what we call tax credit. And mind you, that is only possible. A company only recognizes a tax credit when it's possible that that company can go back and offset this tax credit against its tax paid previously. So always, it's not about payable, we can also recover tax. So that's the meaning of tax recoverable. But this is in respect of tax loss. Payable is in respect of taxable profit. So you can see it from the definition. So payable goes with taxable profit, whilst recoverable goes with tax loss. Do not forget. Now, based on the algebraic expression I have written here, we are saying that we only charge our current tax on our taxable profit. Current tax is derived or determined by multiplying our tax rate on our taxable profit. Now the question is, what is a taxable profit? That means there is another type of profit. If we have taxable profit, then we have what we also call accounting profit. So what is the difference between accounting profit and taxable profit? Let's quickly look at that. So we have taxable profits. Taxable profits. Alright, when we talk about taxable profits, is the profits for the period. Profits for the period. For the period. Determined in accordance with regulations established by tax authorities. So when we talk about taxable profits, we are saying that it's a profit for the period determined by who? By regulations, by laws enacted by tax authorities. So when you come to Ghana, the Ghana Revenue Authority, the GRA, as a body, is the one that determines taxable profits for every company. So the difference between taxable profit and accounting profit lies on who is determining that profit for you. So accounting profit is the one that is determined using your accounting principles, your company laws, and everything. You don't use the tax regulations, okay? That is what we call accounting profit. So accounting profit has to do with what we determine based on the company's principle, the accounting standards. Anything that you do to determine your profit for the period is what we call accounting profit. And mind you, our current tax is not charged on our taxable, on our accounting profit. Our current tax is not charged on our accounting profit, it's charged on taxable profit. So any profit determined for the period used when we use the regulations, the laws, the rules that have been enacted by tax authorities, that profit is what we are referring to as a taxable profit. In other words, an accounting profit is also known as profit before interest and profit before interest and tax. So accounting profit is also known as operating profits. Okay, so profit before interest and tax, and also known as operating profit. So don't forget the differences between accounting profit and then taxable profit. Now, how do we determine taxable profit? With accounting profit, we know. I even showed you the format over here. That once we've gotten our gross profit, we take away our operating expenses, and once we've done that, what you get is what we call operating profit. We know that one. Alright, so how do we now get our taxable profits? How to determine taxable profit? Let me use a practice here because I'll be using figures. So how to determine, how to determine a taxable profit. How to determine a taxable profit. Let me merge this cell. Okay. So the first thing is always there is a tax that the company has determined. I say tax, there's a profit that the company has determined. So always we go for the profits before tax. So to determine the taxable profit for a company, you always go for the profit before tax. So we will have gone to the income statement of the company and picked the profit before tax. So we would have gotten a figure here and put it here. Let's say that figure is $150,000 for the period. $150,000 for the period. So what do we do next? Now, there are certain expenditure that have been lessed to derive this profit, but based on the tax laws, they are not supposed to be allowed. They are not supposed to be less before you derive this profit over here. I take it again. There are certain expenses. The most common one is depreciation. That the company has less before deriving this profit before tax over here. That profit, that expenses that the company has reduced or has less from a gross profit to get this profit before tax, that expenses may or might not be allowed by tax authorities as expenses. When that's the case, we need to add back. So we add back all non-deductible, we call it non-allowable. You can also call it non-deductible, okay? Non-allowable expenses or deductions. Let me put it that way. So there are certain things that we are not supposed to list, but we have list. There are certain things you have added you are not supposed to add, like dividends. Dividends is not supposed to be part of your profit, your taxable profit, okay? So we add. So let me rather not use the word add. Let me say adjust. We adjust. That means there are some you add, there are some we will have to, less. So we adjust this particular figure here with all non-allowable deductions. Okay, so this is deductions we have made, so we add back. So the add back is correct. The add back is correct. Yeah. Then if then we add, then we less all non-allowable additions. So this figure here includes, let's say, dividends for the period. We less because it's not supposed to be part of our taxable profit. Then depreciation. Depreciation is also an amount that is not supposed to be less before we get this figure. Okay, depreciation. So that one too is what is added back. So anything that is not allowed by the tax authority, they will give it to you in the question. They will give it to you. Then anything that is also added and is not supposed to be added, we also less those ones. Then after you've done that, then you will now less the allowable deductions, mostly what we called what's the name? Capital tax, right? In respect of capital allowance, sorry, not capital tax, capital allowance. In respect of the depreciation, the tax authorities will now give you what we call capital allowance. Capital allowance. And capital allowance is also a very broad topic on its own in the taxation courses, right? It's a very broad topic and it's not treated in income taxes. So we less our allowable deductions, okay? So anything that is allowed by the company to be less, which has not already been less. Mostly this one is what we call the capital allowance. Capital allowance. Now we less this one from whatever figure we are getting here. Okay, whatever figure we are getting here. Once you've done that, the final figure is what we call taxable profits. Taxable profits. So this is how to get your taxable profit. Now the question, I know most of you are confused. If in case you are meeting this, or you've not met some of these things before in income IAS 12, and then I'm now teaching it. Yes. So when we started the discussion today, I emphasized that there is courses on taxation, and the scope of IAS 12 does not go beyond, does not come to this extent. So all these things I've done here, they are things that we have in a taxation course as a whole. So most questions, I've not seen a question aside the university ones that the lecturers want to punish you. I've not seen any question that would demand that to determine your taxable profits. I've not seen any question, both ACCA, the accountancy, professional FR, and then corporate reporting FR, corporate reporting courses. I've not seen any question that demands that you determine your taxable profit, but at least you have to know. That's what I'm teaching you. So first of all, you take your profit before tax. We add back all non-allowable deductions, and we less all non-allowable additions. Then whatever we get, we less our allowable deduction, which is the capital allowance. Then we get our taxable profit. It is based on the taxable profit that we charge our tax rate on to get our what? Current tax. Current tax. If in our accountancy exams or in what we do, this is not required, then how do we get our current tax? What is required of us to get our current tax? What is required of us to get our current tax is the principle of over and undercharge tax. I take it again. What you are required to do in most exams when it comes to current tax and IAS 12 is that you are supposed to provide, you are supposed to account, or let me use the word account, for what we call over stroke or undercharge tax. So this is what you do to get your current tax for the period. This is what you do to get your current tax for the period. So it is for you to, determine your overcharge or undercharge tax. Or another word will be under or overcharge provision. Okay, under or overcharge provision. Why provision? Because always, like I said, our current tax is a tax that is payable, and I said that payable is a provision we make. So over provision or under provision of tax. Okay, so another word is over provision or under provision. How do we deal with under provision and over provision? Okay. All right. So how do we deal with over provision or under provision of tax? Let's go back to what we started with earlier with these figures I've indicated here. Now, I said that mostly the current tax, we made provision for it. So assuming this year, the provision we made is 100. Now the tax authorities will come and check what we have made and what we have to pay. Are they the same? Now what you have to pay based on the tax authorities audit is $120, but what you have provided for is 100. Then this is where the issue of over provision or under provision is coming in or is setting in. Anytime what you provided for is lesser than what the tax authorities demand that you pay. So anytime what you provided for, so what we provided for here is 100, but what the tax authorities are demanding that you pay is 120. Anytime you do this, we call it under provision of tax. So under provision is, let me put it here. So under provision is equal to when the tax provided for is lesser than what tax authority demand that you pay. Okay, so anytime the tax you provided for and what the tax authority demand that you pay is higher, right? What you provided for is higher, then we call it under provision of tax. Under provision of tax. Anytime you under provide for your tax, you need to add the differences, the treatment. I'm teaching the treatment. How do you derive the under provision? Is comparing what you have provided for and what you have paid. And the difference is what is giving you the under provision. So in this particular scenario here, our under provision is going to be 20 because we provided for 10, but we are required to pay for what? For 20. So the difference between the 100 and then the 120 here is going to be 20. So that 20 is going to be our under provision. How do we treat the under provision? We always have to add. So treatment, we always have to add. So add to the current tax provision. You see, under normal circumstances, we are supposed to go back to the previous period and add here. We are supposed to go back here and add the 20 to it so that it will now tally. Okay, but remember that our income statement takes care of year to year, period to period. We can't go back and do that. We can't go back. We can only do this in the statement of changes in equity, but we don't want to also do that. So what we do is that we treat this in the current period. So what is our current? This is what we paid. This is not part of our income statement. We always have, remember that the tax expense in our income statement is always the current tax and deferred tax, not the tax we have paid. The tax we have paid is a cash item, something. So this is what we have actually paid. This is not part of our income statement for 2024. So when we come to 2024, this is our current tax we are making provision for. We need to add that under provision. We need to add that under provision. So our tax will now be 20 plus the 150 that we have made provision for. So always remember that under provision is added. We add it to our current tax we have provided for. We add. Don't forget, under provision is added to our current tax we have provided for. Do not forget. Please, this is the examinable one, not the determination of taxable profit. That's why I'm taking my time with this. So we always have to add our under provision of tax to the current tax we have made provision for. All right. I think I've changed this one. Okay, let's look at over provision. So the vice versa is true for over provision. Over provision. So the vice versa will be true, which is anytime the tax we provided for, let me just copy and paste over here. The tax we provided for is higher or is greater. Is greater than what the tax authorities demand that we pay. That gives you the scenario of over provision of tax. So let's come to the practice side. So we have made provision for, let me use different dates over here. So let me use 2026 and 2027. So let's say we've made a provision for 200, and then the tax authorities are demanding, after everything, we are supposed to pay 170 dollars. This is what we make provisions for. But when we go to the next period, they are demanding that we pay, this is what we are supposed to pay, 170 dollars. But we provided for 200. You see, what we provided for is more than what we are paying. So anytime what we provided for is more than what we are paying, that scenario is what we call over provision of tax. Over provision of tax. And with that regards, what we have to do is that we have to less it from our current tax provision. So we less. So with that one, the treatment is that we less from our current tax provided or provision. Our current tax provision. So the current tax that we are making provisions for, we have to less that particular over the provided tax from. So assuming that in 2027 we are making a provision of 260 tax. What it means is here is that we need to reduce this tax by our over provided tax, which is going to be 30, because the difference between what we actually paid here, what we actually made a provision for, what we actually paid here is 30. So we need to influence our current tax provision with the over provision of tax. So basically, this is how to determine your current tax in most of your questions. In worst case scenarios, that is when you will be asked to determine the taxable profit before you multiply it with your tax rate to get your current tax. That is mostly, some of these things are done at a university level when lecturers want to be a bit wicked, because it's not part of IAS 12. This is supposed to be done under normal taxation courses. Now that you know how to determine over provision or under provision of tax, let me add some trick to it. So remember that to determine your over provision is comparing what you provided for and what you paid. And the same way, to get your under provision or under charge tax is what you provided for and what you paid. But in some situations, mostly in the professional exams, there will be silence on how much you paid, and there will be silence on how much you made provision for in the previous period. The only thing you will see is the trial balance. So let's take an example. In this example, I'm using the ICAG FR paper, past questions. So let's look at some of them. Let's take, for instance, let's take April 2022. Okay. First of all, let's go through the trial balance and see if you see any balance on income tax or current tax. So let's go through. So we have deferred tax here, and they said we should go to note 4. So this is the deferred tax. So we won't. Let's go to note 4 and see if you have anything to do with current tax. So they said the directors have estimated the provision for income tax for the year ended 31st December 2020 at 12,000. So here you see there is no issue of previous tax over provision or under provision. If there is one, then we should see it in the trial balance, but there is no issue. That means what they make provisions for and what the tax authorities asked them to pay in the previous year, which is 2019, they were all the same. So there is no provision, there is no over provision, there is no under provision. This is just let's come here. Assuming we make provision for 100 and the tax authorities are saying we pay 100. You see, there is no over provision, there is no under provision, and that's what we are seeing in this particular question. So what you have to account for is the current tax they have made provisions for. Is the current tax they have made provision for. All right, let's pick another one. Let's pick, let's say July 2024 and see. So Fumba estimates an income tax provision of 122.4 million Ghana cedis is required for the year ended at the date the deferred tax. So they have also given us this tax. Let's look at the the trial balance and see if you have anything to do with current tax. Here again, we are seeing deferred tax alone. We have not gotten there, so that's I'm not talking about it. So there is no issue. Okay, there is one here. This is what I'm looking for. There is one here. Now you see, this is what I'm talking about. There is a current tax here of 5,400. There's a current tax here of 5,400. Now, if you go to note 4, there is nothing. The question never made mention of over provision or under provision. The question is just silence. And if you don't know and you don't account for over provision or under provision, all that you're going to do under taxes is wrong. So always, you have to look at the trial balance. What is happening in the trial balance? You see, in the previous question that I opened, there was nothing about current tax. With that, you have to assume or you have to conclude that there is no over provision, there is no under provision. But in this question, if you assume that there is no over provision and there is no under provision in the current period, you are totally wrong. It's wrong because there is a current tax here in the trial balance. So anytime questions are silenced, this is a trick I'm showing you. So I said I'm showing you a trick. Anytime the questions are silenced on as to whether it's a over provision or under provision. They didn't say anything. You have to go to your trial balance. Check, is there any balance on current tax, or there is no balance on current tax? The issue here is current tax. Sometimes they will make it income tax. It's the same thing. So sometimes the income tax is the same as current tax. So check, is there any balances on it in the trial balance? The next thing you are supposed to check is which side is the figure. Is the figure at the debit side or the figure is at the credit side? Hello, I take that one again. For us to determine this over provision or under provision, always after, if they give you the scenarios like we had earlier on, what we make provision for and what we paid. Now you can just find out the differences to get your over provision or under provision. But when the question is silent like we have here, if you go to note 4, they didn't tell us anything. Let's read these notes. Let's see if they have given us any issue or any information on over provision or under provision. Let's read. FUMBA estimate that an income tax provision of 122.4 million is required for the year ended 31st March 2023. And at the date, the liability to defer tax is this is for the current period. If you reach the requirement, this is the tax they have made provision for in the current period. Look at the requirement over here. The provision for the current period. Let's read it. The tax balance on the current tax. Now they are giving you information on your over provision, but they didn't say anything under over provision or over provision. They didn't say anything, but this is the information. The balance on your current tax in the trial balance represent under, this here. So this question is a bit lenient with us. They have given us represent the under or over provision of tax liability for the year ended the previous period, 2022. Now the question is that figure over provision or under provision? Is this figure here over provision? Because they didn't tell you. How will you know? But you will know whether it's at the debit side or the credit side. So you always have to check the current tax. Is it at the debit side or is it at the credit side? Is it at the debit side or at the credit side? Now let's go to I'm not going to tell you. Let's go and do it so that in case you forget, you also apply the same principle to determine whether it's a over provision of tax or under provision of tax. Let's quickly get a T account. So a T account, let's put here tax expense. Tax expense. All right. So this is the middle. Oh, it should be just 2. So a T account should just be the debit side. So this is our debit side, this is our credit side, right? Okay. Anytime it's a provision of tax. Anytime it's a provision of tax, we know we have what we call it's supposed to be a liability, right? Because it's a provision. Okay. So I'm using the first example. So we made provision. This is supposed to be 120. Okay, so we made provision for 100. It's a liability. Provisions are liability. So let me put here provision. Provisions are liabilities. Okay, so we made provision of 100. Okay, and then the tax authorities demand that we pay. So we paid 120. Okay, so let's balance this account. So our balance carried down will be here. Our balance carried down will be here. So balance CD will be here of what? 20. So at the end of the period, so let's find the total. The total here will be 120. This will also be 120. Okay. So this will be the final thing. Then our balance brought forward will come to the debit side. So now we are going to basis of accounting. If your foundation, your double entry principle is wrong, this is where you have to, you will need it. So that's why you always have to know the basis of accounting, your double entry principle. Okay, so but the balance BD, forgive me if you don't know some of these things, but just follow. Okay, so once we have our balance carried down over here, the balance brought down will be at this point, which is also going to be 20 over here. Now, at the end of the period, this is what we use to prepare our trial balance. This is the final thing. This is what we use to prepare our trial balance. So when you go to the trial balance, this figure here will be at the debit side because the balance brought down is at the debit side. Now, from this thing we have seen here, what is this? This is what? This is an undercharge tax. Undercharge because, or under provided tax, under provision of current tax. This is it because what we provided for is 100, what we paid for is 120. And look at where it is. It's at the what? It's at the debit side. So under provision is always, this is what I just want to show you. I don't want to give it to you. I want to come and show you with practice. Under provision is always at the debit side of the trial balance. Under provision is always at the debit side. Write it somewhere. Under provision is always found at the debit side of the trial balance. Whilst over provision is always found at the credit side of the trial balance. So in this question, all the information this is giving to us is that this 5,400 here is an under provision of tax. And for us to get the current tax for the period, we need to add this 5,400 to the tax that they have made provision for, the 122 million. So the addition of that plus this will give us the current tax for the period because under provision of tax is added whilst over provision of tax is less. If you don't have any question, that is it for current taxes. So by provision of tax is at the credit side of the trial balance, whilst under provision of tax is at the debit side of the trial balance. Any question, please? We are done with current tax. Any question? We will solve some questions when we are done with everything. All right, so that is it with current tax. That is it with current tax. So from the beginning, we emphasize that the amount we send to our income statement as tax expense is made up of both current tax and deferred tax. Now we've taken our time to go through all the things we need to know under current tax, how to determine it, and yes, and how to account for by provision or under provision of tax. If we found it in the trial balance, what does it mean? And how do we deal with it? At the debit side, remember it's what? It's under provision, and at the credit side, it's over provision of tax. And one is over provision, we less from the current tax provided for, and one is under provision, we add to the current tax provided for. And that is it with current tax. We can proceed to look at deferred tax. But before that, we can go for a break of 5 minutes. It's now 5:13. So we are going for a break for 5 minutes. We'll be back at 5:18. So see you soon. Bye for now. Deferred tax. All right. So we are now with everything that we need to know under current tax. So now we want to look at deferred tax. Deferred tax. What is it about? How do we derive it? And what are some of the things we have to do? Deferred tax. All right. From here, I'm using mostly the ICAG questions, but when you take the ACCA questions as well, the approach and everything that we do here is the same, right? Yeah, it's the same. And then also, most of the things, most of the questions, some of them are even much more easier than what we do under the ICAG. So that's why I'm using the ICAG questions, because most of us here are from Ghana, and that's what we are going to write. But if you want to write ACC as well, it's not anything that should be difficult once we are able to solve this, right? And I also use the ICAG. No matter where you find yourself, once you're able to solve some of these questions at your jurisdiction or in your country, you should be able to solve all questions that you encounter under the standard. What is important is understanding the standard, not about chewing and pouring, not about, once you understand, you have the principle, you will be able to solve any questions that you encounter. Now, deferred tax. We said that current tax is a tax that is payable or recoverable in respect of our taxable profit or tax loss. Now, what is deferred tax? Deferred tax is a future tax consequence. So when we talk about deferred tax, so let's move here. So deferred tax is a future. So whilst we have current tax, we also have to defer tax, and this one is a future tax consequence. A future tax consequence. Is my consequence correct? Future tax consequence. I think it's like this, right? We proceed. So it's a future tax consequence. If the consequence is not correct, please correct it at your end. So it's a future tax consequence in respect of what we call taxable differences. Okay, taxable differences, or we call it, instead of taxable differences, let's make it temporary differences. Okay, temporary differences, because taxable differences is, you know, we will be specific if you make it taxable difference. So we call it temporary differences, right? So a future, when we talk about deferred tax, is a future tax consequence in respect of temporary differences, in the respect of temporary differences. So once we have temporary differences, then we should have permanent differences. But deferred tax does not arise in respect of permanent differences. It arises as a result of temporary differences. Now, mind you, some of these things are very important because you can be examined on them. You see, this standard alone is not always the case that it's formed part of a full standard. Sometimes you can be examined on it as a full package, as a standard. If you care to know, let's go to this question. This is April 2022, that is ICAG. If you pick question 2, let's go to question 2. If you pick question 2, I think, yeah, question 2. Look at, there's a full question on it over here. Even how to explain the term temporary difference. You see, there's a full question on it. So the standard is a very, it's a comprehensive one that you need to get all the principles, so that anytime you find yourself having any question in front of you, you should be able to solve it. So when we talk about deferred tax, it's a future tax consequence in respect of temporary differences. In this case, let me make temporary difference because I'll be meeting it a lot. Let me make it TD, temporary difference. Now, let's explain the terms. When we say future tax consequence, what are we talking about? The name is from deferred. Okay, they are facts that we enjoyed some of the benefit today, mostly when we talk about a non-current tax. The carried amount of that tax is enjoyed until we exhaust all the carried amount from that particular asset. At the end of it, either we dispose it off or we even throw it away. But it is at the end of each period that we are fully exhausted, we are fully enjoyed it all benefits. All that I'm trying to say, that assuming we have an asset having a useful life of 10 years, it's after that 10 years that we have fully utilized the benefits of that particular asset. But this asset is used to generate revenue for the company, which is taxed. Once this is the scenario, that means this asset, this non-current asset, which is having carried amount, which we will be using for the next 10 years, must be taxed at the end of its useful life. But if you wait till we charge that tax, our accounting period, the matching concept will be what will be wrong. We say we match revenue against expenses. So for these reasons, for us not to overstate our financial statement, our profit for the period, there is a need for us to account. In fact, deferred tax is not the actual payment of tax. It's an accounting principle. It's an accounting treatment. All as we see under the current tax, deferred tax is an accounting treatment. It's for us not to overstate. It's for us not to violate the tax regulations. These are the two reasons for which we account for deferred tax. Because it's a future tax consequence. Okay? Because we are going to enjoy the benefit from the assets today, we are computing deferred tax on it so that at the end of the period, we would have known the full deferred tax we have paid on that particular asset. So it's like I indicated on, it's not an actual tax payment. It's not actual tax payment. It's what? It's an accounting principle. So in a layman's understanding, when we talk about deferred tax, the future tax consequence over there is that, you see, the carrying amount of the assets is going to be enjoyed over a period of time. But we charge that carried amount in the form of depreciation to the income statement, right? Now this asset is going to be used to produce revenue for us, which is taxed. That revenue is taxed. Because of all these two principles, we are saying that we are supposed to charge deferred tax on it. In another word, when you want to determine your tax, the depreciation percentage that you use to determine your depreciation on the assets, and the one that the tax laws will give you, mostly there are differences. You may be using 10% depreciation, tax laws will give you 20%. Because of that differences also give rise to what we call temporary difference. Okay, what you do as an accounting firm or as a company, and what the tax authorities are also giving to you to do, the differences in them create what we call temporary difference, which give rise to what we call the future tax consequences. We will come to temporary difference. Okay, so in a nutshell, when we talk about future tax, when you talk about deferred tax, it's a future tax consequence as a result of what is happening today, as a result of our temporary differences. So I'll give you one difference, is the depreciation. There are some times where there are certain things that the tax authorities are allowed to be deducted from our tax, but the company, so it's not allowed to be deducted from the tax. No, if we take it from that angle, we may be wrong. Okay, let's take it from this angle. There are certain things that, like for instance, let's say salary is an allowable deductions. Tax authorities allow it to be less from our gross profits before we derived our profit for the period, or before we derive our tax to be paid. Okay, it's allowed. Companies to allow this as an expense. You see, these two, they allow it, but sometimes it happens in different periods based on the accounting period and then the tax regulations period for the company, or for that particular company. Because of that differences, those differences is what is giving rise to what we call the deferred tax. I'm trying to explain to you what the meaning of deferred tax is. But if you don't get it, please take your time. It's not anything difficult. By the time you are done with all the principles and the deferred tax, you would have appreciated them more. Okay? Okay, so now let's focus on what is temporary difference. When you talk about temporary difference, in this case, TD, it's very simple. Temporary difference is the difference between the carrying amount, in another words, net book value. Okay, carried amount is the same as net book value. You look at it under IAS 16, right? Carrying amount of an asset. I'm using assets here, but it can also be liability. Okay, so it's the difference between the carried amount of an asset and its tax base, The difference between the carrying amount of an asset and its tax base, that difference is what we call temporary difference. In other words, algebraically we are saying that temporary difference is equal to our carrying amount minus our tax base, the difference minus our tax base. The difference between carried amount and tax base is what we call temporary difference. Now, how do we derive our carried amount? Carried amount is basically the cost of the assets, minus accumulated depreciation. In this case, accumulated depreciation. Sometimes we go ahead and less our accumulated impairment or impairment loss. But in this case, carried amount is cost minus accumulated depreciation. Don't forget, that's how we get our carried amount. All right. Let me take it from this formula. Let's go down. So what is carried amount? Carried amount in this case is going to be our cost of the assets, costs minus is the cost of the asset, okay, the original cost minus our accumulated depreciation. Sometimes we also less our accumulated impairment if there is any, right? Okay, so that's how we determine our carried amount. Carried amount is basically the net book value of the asset. After the day, how much do we still have? What is the value of the asset? The net book value, right? That's the carried amount. What is a tax base? What is the tax base? Because we say that temporary difference is the difference between what? Between the carried amount of an asset or a liability and each tax base. So what is a tax base? A tax base is an amount attributed to an asset or a liability for tax purposes. So an amount attributed to an asset for tax purposes is what we call tax base. You can be asked to explain some of these concepts like we just saw, right? So please, you have to know how to deal with some of these things. So tax base is basically an amount attributed to an asset for tax purposes. But algebraically, if you want to use mathematical terms, we want to say that tax base is also known as is equal to the cost of the asset minus accumulated capital allowance. You see, it's very simple. Capital allowance. So we say that the deferred tax is a future tax consequence in respect of what our temporary differences. What is the temporary difference? Temporary difference is the difference between the carrying amount of an asset and its tax base. We getting it? Now we've gone further to determine what is a carried amount, and we are now determining what is a tax base. And we are saying that tax base is an amount attributed to the asset, the cost attributed to an asset or liability for tax purposes. That is what we call tax base. And if you want to determine your tax base in any question that you encounter, is always your cost, the original cost of the asset. Then we take away our accumulated capital allowance. The rate that is allowed by tax authorities for depreciation purposes is what we call capital allowance. So to replace your depreciation, what the tax authorities gives to you or give you to determine is what we call our capital allowance. But mind you, to determine your carrying amount, it's your cost of the asset minus your accumulated what? Depreciation. Accumulation simply means when we add more than 1 year depreciation, when we add more than 1 year capital allowance, that makes it accumulated, not anything, strange. Okay, accumulated doesn't mean anything strange. It's the summation of yearly depreciation or capital allowances that makes it accumulated. So basically, once we've known this, or we've gotten this principle that deferred tax is a tax consequence, then we can go ahead and now conclude that therefore deferred tax, deferred tax is equal to our temporary difference multiplying our tax rate. Multiplying our tax rate. Right? Because to get your deferred tax, we said it's a future tax in respect of our temporary difference. So it's a temporary difference multiplied by our tax rate that gives us our deferred tax for the period. For a particular period. I'll teach you how we account for deferred tax. I mean the presentation of deferred tax. So deferred tax is our tax temporary difference multiplying our tax rate. And what is the temporary difference? The difference between the carried amount of an asset and its tax base. What is carried amount? The cost of an asset minus accumulated depreciation. What is tax base? The amount attributed to the asset for tax purposes, and that is the cost minus accumulated capital allowance. So from all this scenario here, this question we should be able to solve this question without even me coming in. We should be able to determine the carried amount of it. We should be able to determine the tax base, and we should be able to determine the temporary difference, and we can apply our tax rate on it. But before then, let me also teach you something. Let me teach you a trick. There are two forms of deferred tax. There are two forms of deferred tax. We call one is deferred tax liability. Deferred tax liability. And another one is deferred tax. Deferred tax assets. So there are two forms of liability. And these two forms of liability will always emanate from what you are having as a temporary difference. So there is something we call taxable temporary difference and deductible temporary difference. So the type of temporary difference you get determines whether it is a deferred tax liability or is a deferred tax asset. So we know temporary difference, okay? Now, what gives rise to deferred tax liability is what we call taxable temporary difference. And what gives rise to deferred tax asset is what we call deductible temporary difference. I hope you are following. So anytime you are given a question, it is left with you to determine whether this is a taxable temporary difference or a deductible temporary difference, because it is this, based on this, that you will know whether it's a deferred tax liability or it's a deferred tax asset. So I think you need to take your time and digest some of these formulas. Okay, you need to take your time and digest these formulas. Now, under what circumstance do we get taxable temporary difference? Anytime you compute for your carrying amount of the asset, when your carrying amount of the assets, the carrying amount is greater than your tax base. Is greater than your tax base. Is greater than your tax base. What we get is taxable temporary difference. So when you compute for your carried amount is $100,000. You compute for your tax base and it's $90,000. You see, the tax base is lesser. Anytime your carried amount is greater than the tax base, what you get is what we call taxable temporary difference. If you charge your tax rate on that temporary difference, it will give you what we call deferred tax liability. The vice versa is true for deferred tax assets. Deferred tax assets. So when our carried amount is lesser than the tax base, that gives us what we call deductible temporary difference. And once we charge our tax rate on it, it gives us what we call our deferred tax assets. Please, any question, any confusion, should I go over it again, or we are cool? Once we are all silent, it means we can proceed.
Please, we'll kindly go over the tax liabilities and then the deductibles again.
All right, sure. Thank you. So I'm going over it again. That so I think from up to tax base and then our temporary difference, I think it's fine, right? So for us to get our temporary difference, remember, is the carried amount, the difference between the carried amount. So you would have determined your carried amount, you would have determined your tax base by using the simple formulas I've established over here. So our tax base here is going to be the cost of the asset minus our capital allowance. We are going to take an example very soon. Then our carried amount is also going to be the cost of the assets minus accumulated depreciation. The difference between these two, so if you determine your carried amount, let's say you determine your carried amount and the figure here is $100,000, $100,000, and you determine your tax base and the figure here is $90,000. You see, so it's just for you to see whether it is a deferred tax liability or a deferred tax asset. Always you have to compare the carried amount with the tax base. The comparison between the carried amount and the tax base tells you whether it's a deferred tax liability or deferred tax asset. But it doesn't go there directly. You have to look at your temporary difference, because we said our deferred tax is the temporary difference multiplying our tax rate. So the deferred tax in this question is what? The temporary difference multiplying the tax rate. But what kind of tax rate are we getting? The kind of tax rate you are getting depends on the amount of the carried amount and the amount of the tax base. So do you know what I do? You just keep this one of the formula in head. Keep this one. The vice versa is true. If you want to keep the two, sometimes it's confusing and you may forget about it. So I just keep it. When I was teaching, I just keep the first one. I know the first one, and I know the second one will be true. So always keep the first one. Keep this one, that anytime the carried amount of the asset is greater than the tax base. In this question, the carried amount is $100,000, which is greater than the tax base. The result is that we will get what we call taxable temporary difference. Taxable temporary difference. So in this case, our difference, our temporary difference will be taxable temporary difference of how much? Of $10,000. The difference between the two. We said temporary difference, the difference between the carried amount of the asset and what? And its tax base. So the difference between the two. But we know that the carried amount is greater than what? The tax base. For that matter, is taxable temporary difference. So now if you apply our tax rate of 25% on this 10,000, whatever result you will get becomes deferred tax liability. Deferred tax liability. Why? Because the carried amount of the asset is higher than the tax base. If you want to understand this, it's because of it means that we are enjoying much now, and we will pay less later on. Okay, we are paying much now and we are paying less later on. If it is deferred tax asset, it means we are paying less now, but we will pay high in the future, since it's a future tax consequence. So get these formulas off your fingers if you want to appreciate deferred tax properly. Some of the questions, they won't tell you. I once saw a question. Do you know what they wrote? They said, they gave the preamble like this. They said, and the deferred tax or something like that is higher. They gave a scenario that made it that it's a taxable temporary difference, but they put it in the scenario form. They put it in the statement form. It's one of the professional past questions, right? I think ACC or something like that. So they put the thing in the scenario form that I think the carried amount I think they said the carried amount is greater than the tax base or something like that. in some funny way. And once you know this, you should be able to know that, oh, that will give you a deferred tax what? Liability. Deferred tax liability, and you don't have to what? Worry yourself. So get the formulas, get the understanding as well. And anytime you are you are confronted with any form of question, you should be able to what? Deal with it. Once again, to get your deferred tax liability comes from when the carried amount of the asset is greater than the carried amount of than the tax base, right? And then you charge that rate on the taxable temporary difference, and what you get is what we call deferred tax liability. The vice versa is true. When the carried amount is lesser than the tax base, what you get is deductible temporary difference. When you charge your tax rate on it, that gives you your deferred tax assets. All right, we've been talking about tax rate. What form of tax rate are we looking at? In under the current tax, we talk about tax rate. Here again, we are talking about tax rate. What kind of tax rate are we looking at? We are looking at tax rate that has been enacted at the end of the period. A tax rate that has been enacted or substantively enacted. So we use the tax rate that has been enacted by the tax authorities, or that is in the process of being enacted, but it has passed, it is at the substantive stage of being enacted. And we also use the most current tax enacted. Hello. So this can be let's take a practice over here. So let's say we are dealing with 2025, okay, and we have March. So we are talking about tax rates, that tax rates should be the rate that is being enacted, or being enacted, if there is the process of being enacted, but it has passed the substantive stage. And we are saying that we are using the most current tax. So I think I was giving an example at the practice sheet. So let's assume this is 2025, okay. By March, they enacted a tax to be 20%. Then in June, there is another. They also enacted one to be 10%. Then, after the date that we are preparing our account, they are trying to also enact one, but that one is in a substantive, is at a substantial stage. So after that is, let's say, September. So that one is 15%. And there is a rumor or something like that. Yeah. Is that correct? Something like that. A rumor that our tax is supposed to be 18%, right? Okay, so among all these rates, which one are you going to use? So I said something earlier. We are looking at the most current enacted or substantively enacted. So anything rumor, hearsay is not a tax. Although this is the most current, let's say this is December, that there will be tax change, but it's a rumor. This will not be used. We go to the next one. This has passed the substantial stage, so we can use 15%. The most current that is being enacted, or that is in the process of being enacted, but has passed the substantial stage. So that is what we're going to use over here. So that is it with the tax rates. Please, under IAS 16, anytime there is an upward revaluation of an asset, we will look at it later on. Anytime there is an upward revaluation of an asset, the increment in the revaluation, we must always charge deferred tax on it. Please put it somewhere. I'm not going to write, but put it somewhere. Increment, in fact, revaluation gain must always attract deferred tax unless otherwise stated in the question. Revaluation gain or revaluation surplus. Revaluation gain or surplus must always attract deferred tax, and at that point tax base is always 0, so that is going to be a taxable temporary difference, which will give us our deferred tax liability. So the deferred tax always charged on revaluation gain or revaluation surplus, they are always a taxable temporary difference, and which give rise to deferred tax liability. So unless otherwise, unless the question say don't ignore, unless the question tell you to ignore deferred tax on it, that's when you ignore. Even when the question is silent, it didn't tell you anything, you need to charge deferred tax on the revaluation surplus or revaluation gain. So don't forget. So revaluation gain or surplus must always attract deferred tax unless otherwise stated. Alright, so on these notes, we are done with IAS 12. Yeah. What is left is for us to solve questions. So let's solve some questions. We will solve, we have more time. We are supposed to close at 7 and it's now 6, so we have about an hour more. So we will solve about 3 or 4 questions that will help us to establish our understanding. Alright, so let's go to the practice sections where you'll be solving the questions. All the questions you'll solve is going to be past questions on ICAG, right? Yeah. So let's look at this. This is April 2022 FR paper, and here they are asking the questions on this one. IAS 12. Let's see. Big Green Limited, I'm reading from the beginning. Big Green Limited is an agro-processing company which reports under international financial reporting standards and prepares its financial statement up to the 31st December year each year. The company intends to comply with IAS 12, which is income taxes, by introducing deferred tax in each financial statement on 1st January 2020. So please, if you want to appreciate financial reporting or corporate reporting more, date is important. So on 1st January, that is the starting of the business, they acquired a plant costing 750,000 Ghana cedis and has a useful life of 5 years. So you can see a useful life of 5 years. The cost is 750,000, a useful life of 5 years, and it has no residual value. Big Green enjoys capital allowance. You see, they enjoy capital allowance at a rate of 30%. So they are also enjoying capital allowance at a rate of 30% over a year. Revenue generated by using the plant is taxable. Always, this statement is there. When I was giving the presentation, I think I said it. It's some of these that give rise to the deferred tax principle, because we are enjoying the benefit of the asset and the benefit will be taxed. Then we must account for deferred tax just to avoid the issue of overstatement of our profits, over understatement of our profits. Any gain on disposal of the machine will be taxable. Any loss on disposal will also be deductible for tax purposes. You see, so when we sell the asset in the future, it will be taxed. For this purpose, we need to charge deferred tax on it. And then Big Green estimates current provision of tax. So they have also given us our current tax to be here, to be this one. The tax rate is 25%. Now let's look at the requirement. In accordance with IAS 12, income tax is plain. So the word is explained. They didn't say account or they didn't say compute. That means whatever you do, you must be giving notes on it to get your full marks of 5. The word is explain. They didn't say compute. So once you are giving us the calculations, add some notes to it. Okay. Explain to be reported, the amount to be reported in the statement of financial position and a statement of profit or loss for the year ended 31st of December 2020. So this is another important date, and you compare with the first date that we saw, the January 2020. Okay, so let's list the ingredients in the question. Let's list the ingredients in the question. So let me put here ICAG April 2022 question 2. I think it's A or C, just for reference sake. Question 2A. Question 2A, right? Okay, so what's the cost of the assets? The cost of the asset is 750,000. 750,000. This should be figure. Okay, then useful life. Useful life is 5 years. Useful life in years is 5, right? Then what is our we're giving capital allowance. Capital allowance rates is 30%. Yeah, what else do we need? The dates, right? The dates. So we have we're giving the asset was bought on 1st of January. Okay, so we're also giving the tax provisions, 10,125. Let's put that one to there. So current tax provision of 10,125. All right. Okay, so first thing first, how do we determine our deferred tax? We have already been given our current tax provision. There is no under provision or over provision from the question, so we don't have to look at that. Now the issue is how to determine our deferred tax, right? So the first thing is to determine our carrying amount. So the first thing first, so we determine the carrying amount. So determine the carrying amount. All right, how do we do that? So what is our annual depreciation? Annual depreciation. So annual depreciation here is going to be the cost of the asset. Let me put into brackets. It's going to be the cost of the asset. Since we didn't do IAS 16, pardon me, you will do it right soon. So the cost of the asset divided by the useful life. The useful life is the cost minus residual value, but here the residual value is 0, is nil, right? So it's the cost minus residual value divided by the useful life. That will give us our annual, so our yearly depreciation. Okay, so in this case it's going to be the 750,000. It's going to be the 750,000 divided by 5. That will give us our annual depreciation, our yearly depreciation. So here 750,000, I can just use here this divided by this should give us our annual depreciation. Then we said our carried amount. We need our accumulated depreciation. So this is where you have to be very careful. From the date of the purchase, the date we acquire the assets, is from 1st January to the date we are reporting, which is the 31st December. How many years? Here is just 1 year. It's just 1 year. So if it's 2 years, we need to multiply the 2 by this one to get our accumulated. If it's 3, so it's to get your accumulated depreciation is mostly the number of years the asset is used. So number of years multiplying the annual depreciation. Okay, so that will give us our accumulated depreciation. So our accumulated depreciation is going to be, in this case, it's going to be 1 multiplying our annual depreciation over here, and it will still give us the same 150,000, right? Okay, now we can proceed to look for our carried amount over here. So let's come here. Our carried amount, we said that is going to be the cost minus accumulated depreciation, and we have determined all that already. So it's here, which is going to be our cost, which is 750,000, minus our accumulated depreciation of what? 150,000, and it's giving us 600,000. So the carried amount of the asset is 600,000 Ghana cedis. So I hope you see all these will be marked for you. So you have to take your time and present it appropriately, right? And it will be marked for you. So the cost minus our accumulated depreciation. We have now determined our carried amount. Remember that once you've gotten your carried amount, we need to now go ahead and determine our tax base. Based on the principles we just established. Okay, so now let's come here. Let's leave one line. Let's go to how to determination of tax base. Our tax base. Again, we need to find our annual capital allowance. So remember, it's going to be the same thing. Here is percentage. We have been given the percentage of 30%. So is the rate multiplying the cost. So if you are given depreciation rate, we would have multiplied, but here it was a useful line. That's why we are dividing. Don't forget. So the rate. So we are given the capital allowance rate to be 30% over here. So in this case, it's going to be 30% multiplying the 750,000, which is the cost, 750,000. So this is going to give us this multiplying this, and it's giving us 225,000 Ghana cedis. That is going to be our annual capital allowance. Again, we need to determine our accumulated capital allowance. Accumulated capital allowance. And remember, it follows the same principle that we multiply the year times the annual capital allowance. The annual capital allowance, okay? In this case, it's still 1 year. Always the years you use for the depreciation, they must equal. So you use 1 year, 1 year. If 2 years, 2 years. Assuming that this question is asking us to determine the deferred tax at the end of year 2, then we would have used 2 years. Okay, but here is year 1, just 1 year. So whatever you use to compute for the depreciation, the accumulated depreciation, it should be the same year over here. So in this case, it's going to be 1. That is going to be multiplying our annual capital allowance over here. Okay, then once we've gotten our annual capital allowance, we can go ahead and determine our tax base. Remember the formula for tax base. We said that tax base is equal to the cost of the asset. So we said that is the cost of the asset. We take away our accumulated capital allowance. So we less our accumulated capital allowance. We now have everything. We have the cost. We have everything. So in this case, it's going to be the cost of what? 750,000 minus our capital allowance accumulated of 225, and it's giving us 525,000. So we now have our tax base over here. We also have our carried amount over here. Now the question is, we have to compare these two to see whether we are getting taxable temporary difference or we are getting deductible temporary difference. From the calculations we've done here, you can see that carried amount is higher. just even viewing it, we can see that our carried amount is what is higher than the tax base. So for that matter, we are going to get what we call taxable temporary difference. Taxable temporary difference. Now, what you less from this does not matter what comes first. What matter is you giving the temporary difference a name. Okay, so you can less the 525 from this or whatever it is. Okay, so in this case, it's going to be our carried amount. Remember, our carrying amount minus our tax base. Our tax base over here. Our carried amount. Okay. Alright, so in this case, how much is our carried amount? Our carried amount is 600,000 minus our tax base. And this is giving us taxable temporary difference. Why? Because the carried amount is greater than the tax base. So once we've gotten this, then we know that our deferred tax liability, because it's a taxable temporary difference. So we are now going to get that deferred tax liability. Our deferred tax liability is going to be our taxable temporary difference multiplying our tax rate. So we should have, add our tax rate to the information here. So let's go to the question and fetch our tax rate. They said tax rate for Big Green for the company is 25%. So the tax rate is 25%. Here we don't have any issue about enacting. It's not always the case, right? When the questions want to confuse, that's why they bring those things. Okay, so the tax rate here is 25%. So our deferred tax liability is going to be the 75,000, this amount multiplying our 25%, which is giving us 18,750 Ghana cedis. So our deferred tax liability is 18,750 Ghana cedis. So you see, it's an approach one by one, right? So let me put here, let me add one column to it. All right, so let me put here our tax rates to be 25%. All right, so this is how to get the deferred tax. You need to give a note. Now the question demands that we explain how much we should send to our statement of financial position and how much we should send to our statement of profit or loss account, right? Now this is where I wanted to use this question to explain to you the principles of deferred tax treatment. Please, let's go back to our note. Let me put those notes there. When it comes to deferred tax treatment, always you have to be careful. You have to be careful. Yeah. So, what goes to the statement of financial position, what goes to the profit or loss account, you have to be careful. All right. Now, the closing deferred tax is the one that goes to the statement of financial position. So what we send to our statement of financial position is the closing deferred tax. What we send to our P or L, our profit or loss account, profit or loss is our deferred tax for the, let me put it this way. So deferred tax for the period is what we send to our profits or loss account. So the closing deferred tax goes to the statement of financial position, while the deferred tax for the period goes to the profit or loss account. Now, you have to be careful. You have to be careful. Please, you have to be careful. At any point in time, you have to ask yourself, is this a closing deferred tax, or is it the deferred tax for the period? So let's go ahead with some mathematical calculations. To get the closing deferred tax, is going to be your deferred tax for the period, which goes to the statement of profit or loss. So the deferred tax for the period plus your opening deferred tax. I hope you are following. So to get your closing deferred tax, it's your deferred tax for the period plus your opening deferred tax. And what we were seeing in the trial balance in the two questions we saw earlier, what we were seeing in the trial balance, okay, in case of a full question, right? What we were seeing, I think, is it this one? Yeah, I think there was a deferred tax here. Is there any? What is the current tax one? Let's look at
there is bank deferred tax, trade receivables, bank deferred tax.
Oh, sorry. Okay, so there is 1 year. All right, thank you. So there is 1 year deferred tax over here. So this deferred tax we are seeing here is the opening deferred tax. If it's at the debit side, it will be opening deferred tax assets, but it's a liability, because at the credit side, liability is always at the credit side. But if it were to be an asset, you would have found it at the debit side. Mostly, this one is always a liability. Mostly. So we mostly find it under the credit side. So the deferred tax in your trial balance is always your opening deferred tax. The deferred tax in your trial balance is mostly and always your opening deferred tax. Take note of that. Now, what you have been given in the question, you have to ask yourself, is it deferred tax for the period or is closing deferred tax? You always have to ask yourself, is it deferred tax for the period or is closing deferred tax? So let's see. Let's see what we have here. And at the date the liability to defer tax is, you see, at the date the liability to defer tax is this. At the date, look at what they are saying. At the dates, the liability to defer tax is this particular figure here, 42.3 million. You have to ask yourself, is this a closing deferred tax or deferred tax for the period? Please, they say at the dates. If it's for the period, they always tell you, they say at the date. That means as of today, our deferred tax is 42.3. So this is going to be our closing deferred tax. If it's for the period, so they would have informed me that for the period, our deferred tax is this. But they said at the date. So when they quote a particular date for you, after 31st December, our deferred tax is this. That is the closing deferred tax. And if you have closing deferred tax, and in these questions, we also have opening deferred tax. That means we don't have deferred tax for the period. For us to determine the deferred tax for the period is the difference between the two. So our deferred tax for the period, we have found our closing deferred tax in case we are not given. So our deferred tax for the period. So to find deferred tax for the period is mostly your your closing deferred tax, plus, that's a plus, forgive me, minus your opening deferred tax. So the closing minus the opening will give you for the period. And when you add the two, it should give you your deferred tax for the period plus your opening should give you the closing deferred tax. Remember that one of them goes to profit or loss and one of them goes to what? To the statement of financial position. So you see, if you don't know all these tricks and you go and face any exams, you are likely to get the tax aspect wrong. You are likely to make mistakes. So don't forget, what we see in the trial balance is always what? Is always the opening deferred tax. Then you ask yourself in the additional information, what we have there, is it closing deferred tax or opening deferred tax? You have to ask yourself. Alright, in this question, it's much simpler in terms of presentation because we don't have any previous, tax on it. In the question we are solving, we don't have any previous, information on our deferred tax or current tax on it. We don't have anything. So here, if you want to go to the statement of financial position, we will send this to our statement of financial position as our deferred tax, and we will send this again to our statement of financial position under current liability. This will go under non-current liabilities, while this goes under current liability as what? Current tax. Then if you go to the statement of profit or loss, if you come to the statement of profit or loss, so under the profit or loss, let me put it here, P or L, remember it's going to be what? It's going to be the summation of the two, the current tax plus the deferred tax for the period. So these two will go to the statement of what? Profit or loss. So we can just have an extract when you put the, don't forget when we started, I told you that our tax expense is always the summation of the current tax and what? Deferred tax. So now that we are done computing for the deferred tax and then the current tax, the two of them will go to P or L. But when we are done, we will send the current tax we have provided for to the statement of financial position as what? As current, under the current liability as current tax. And then our non-current liability, we will send our deferred tax there because this is a closing deferred tax. Please don't forget. Once again, the treatment. We send our closing deferred tax to the statement of financial position, and then we send our deferred tax for the period to the statement of profit or loss. Now, in most questions, when you are dealing with the full questions, what we have in the trial balance as deferred tax is the opening deferred tax. You have to ask yourself if what you have in the additional information is the deferred tax for the period or is the closing deferred tax. So I'll share this file with you so that I can have, in fact, the recorded, this one will also be shared so that I can have access to the formulas and you can get to know them. All right, let's solve one more. I think we still have some about 33 minutes, so let's solve one more questions. So in this particular question, for you to get the deferred tax for the period, we are going to take the figure here, the 42.3 million. This is also in millions. Don't forget, this is in million because they have taken 3 zeros to the top. Then we take away 27.9 from the 42.3. Once we've done that, you get the deferred tax for what? For the period. That's what we will send to our profit or loss account. Don't forget. All right, let's pick another one. I want us to pick another difficult one. I think it's this one. Okay, so first let's go to the trial balance and check if we have anything on deferred tax, anything on current tax. Let's check. So there is something here on deferred tax. There's something here on deferred tax. Let's look at the date. The date is important. So there's a deferred tax. You see, it's at the credit side, indicating that it's a deferred tax liability. Do we have current tax? Current tax. Current tax. Okay. So there is no current tax in here. There is no current tax here. But they said we should go to note 3. But look at this date, 31st of December 2020. So let's look at the reporting date. Let's look at the reporting date, and we can find this as a requirement. So they said we should prepare for the company as at 31st of December the next year. So this is 31st December 2021, and this is 31st December 2020. So this is the opening. This date is the same as 1st of January 2021. So this is the opening. Okay, so the opening deferred tax is 21,000. Let's go to the additional information 3. So we have more information on that. So this is an additional information. We were not given any information on current tax, but I think it's part of this one. That's why it's very broad over here. Okay, let's read. Taxation accounts represent the aggregate amount paid by the company as self-assessment tax. Now, when we talk about self-assessment, is what we make provisions for, what we do on our own before the accounting people come. The tax authorities come. It's what we call self-assessment tax. Okay, if you do taxation as a course, you'll get to know the meaning of self-assessment. So what we compute on our own as our tax for the period is what we are calling a self-assessment tax. Okay, on our estimated profit, so what we have done on our accounting profit for the 4 quarters of 2021 year of assessment is what they have given us below. So 2021 is the current period we are looking at, right? Now, Kimbuka Limited in the year 2021 had officers of, the GRA coming to audit them again. And after the audit, they have found out that this is what they made provisions for 2019. This is what they made provision for. But this is what they must pay. So based on these two, you should be able to determine whether it's over provision or under provision for these two. Because this is what the tax authorities are saying they must pay. But this is what they actually made provisions for. So based on these two, we can see that the first one, what we paid is more than what the people are demanding that we pay. Okay. We paid, let me use green here. And this is also green. We made provision for 45,000, but they are saying we must pay 43. This is over provision. And in the next year, we made provision for 57,800. And the tax authorities are saying that we must pay 67,600. So this is what? Under provision, right? Okay. The company paid in full the current tax provided for the years 2019 and 2020. So they are done with they've paid all these ones. They've paid these two, but we must account for over provision and under provision. So in the first half of the 2020, however, the difference arising from tax audits have not been provided for. So these differences that we are seeing for 2019, these differences we are seeing for the over provision and under provision is yet to be accounted for. So we need to work on that. They said the current tax expense and increase in deferred tax liability. You see the word, look at the word here. They said increase in deferred tax liability. Increase in deferred tax liability. This simply means deferred tax for the period. Increase in deferred. So the opening and what has added on for this current period is what they have given us. You see, so the statement will always tell you whether it's what is a closing deferred tax or the deferred tax for the period. It said increase in deferred tax. Already there is an opening deferred tax over here. So from whatever we have started the business up to the beginning of this year, there is a deferred tax for us. They said increase. So it means the deferred tax for this period. If it were to be closing, we would have seen a different statement. they would have said that, oh, as at this date, the deferred tax for the period is also and so, but they said increase, right? So the deferred tax is this one, 3750. They are using respectively. So the deferred tax is the second after the end, and then the current tax, which is this one, let me use red, is the 35,300. So they have made provision for the current 2021 year of assessment. Our current tax provision is 35,300, and our deferred tax is 3750. I think with this question, you should be able to understand everything under IAS what? 12. Okay, so now let's solve it. Let's see how we deal with it. First of all, they said they have not accounted for these changes. So let's establish the over provision or under provision under this one, right? Okay, so let's go to our Excel sheet. Let's go to practice again. So let me put here, which year is that? I think this is FR March 2023, question 3. So March ICAG, March 2023, question number 3. All right, so we can make some cells over here and then color it to be the heading. All right, first things first, we need to account for over provision or under provision of tax. So let's give here to be the dates, then this place will be over provision. So what we provided for, so provisions we made, and then what we paid based on tax authorities, okay, the amount paid. All right, then this will give us either over provision, over or under provision. Okay, so let's take 2019, that's the first year. How much did we provided for? So we provided for 45,000 and we paid 43. So we provided for 45,000 here and we paid 43. Okay, so here the difference is what we paid, right, is always what we paid. So what we paid minus what we made provision for. So here there is over provision, okay, and remember over provision we must less it from the current what? The current tax. That's why it is negative, right? So let's look at the next one, 2020, because they said which under normal circumstances we are not supposed to account for 2019 because it's not the most previous year. The most previous year is 2020. But if you read the question, they said that there is a preamble there. They said, however, the differences arising from tax audits have not been provided for in the above balances and are yet to be settled by the company. So they have not done, all the differences have not been done so far. They have not done them. That's why we are doing them. Okay. So 57,800 is the provision we made. 57,800 is the provision we made. 7,800. And what we actually paid is 67,600. 67,600. And you can see that this is going to give us this is an under provision. So for this one it should be positive. Now if you find the total of these two, this plus this, now this is what we are calling the final thing here is what we are going to call under provision because it's higher. Okay, it's what we made provision for and what we paid is higher. So this is under provision. So we are having under provision here, but the previous year there was an over provision. That's why there's a difference over here, right? Okay, so the under provision of 7,800, under provision of 7,800. So when we pick our, let's compute for our current tax expense, current tax expense. okay, or you pick our current tax expenses, is going to be provision for the period, provision for the period, so the provision for the period is how much? So let me put this in a med cell. Yeah, so the provision we made for the period is here. So we are looking at 2021. So the provision they made is 35,300. That's the provision they made, 35,300. Then we add our under provision. Remember, we add under provision and we less over provision. So we are going to add our under provision here, which is going to be the 7,800. So this is going to be our total tax expense. Then if you need, so this is going to be total tax, total current tax over here, which is going to be the summation of this plus this, right? Now if we need the tax expense for the period, tax expense, remember the tax expense for the period is going to be the summation of our current tax and what? Our deferred tax, right? So our current tax here, our current tax for the period is going to be this amount over here. Then our deferred tax, remember they gave us, we need to find our deferred tax for the period, deferred tax for the period. And that is going to be, do we have current tax in the trial balance? Do we have current tax in the trial balance? We need to be careful. Do we have current tax? Look, there is a taxation account. I told if it's not, if we don't see current tax and we see income tax or anything apart from the deferred tax, it's also current tax. So look at this particular one. Look at this trial balance here. So this is the amount they made provisions for. Sorry, this 28,000 is telling us something. Okay, they said taxation account, but this one is an account, and the balance they are having in the account as at this date. So there's a amount of 28,000 over here, right? And we will deal with this when we are dealing with the current tax. So we should have factored the 28,000 over here. So let's put this figure here. Let's put this same figure over here. Then let's put this 28,000 is also under provision. This is at the debit side, right? It's at the debit side. So this is also under provision under normal circumstances, right? So what we do, we are supposed to less, but let's see something, 28,000, and then let's put our under provision, which we have already computed for over here. Now let's add these three and see what we get. This plus this plus this. Now this figure here is the closing current tax. This is what we will send to our statement of financial position. You see, it's the closing current tax. Why am I listing this figure? Because this is what we have as in our account. This is not what we are sending to our profit or loss account, because we have determined that over here already. Okay, we determined that over here already, right? So the current tax is going to be the 43,100. But this one, when we go to the statement of financial position, instead of sending this figure here as our current tax, because of what has happened over the years, this is what we will send there as our current tax. Oh yeah, now we look at the solution and see if we are right or we are wrong. So we effect any corrections in case we are wrong. Okay, so just relax. Then our deferred tax for the period has been given to us. Our deferred tax for the period has been given to us. So we have it for the period to be 3750. 3750. Right? So these two will give us our tax expense. These two will give us our tax expense. This plus this will give us our tax expense. All right, let's quickly look at that, if that is correct. Yeah, so and that provision is here. Look at that expense, 46,850, 46,850. That's from the solution, and is here 46,850. So we are correct, 46,850. And what they send to the the balance sheet, let's check if it's the same thing. Let's check. So is there current tax and then self-assessment? This is what they made. Okay, so the 28,000 is what they have made for 2021. So we don't even call it under provision of a provision. That's why they said taxation accounts. Most of the time they should have given more information on that. Okay, that's why we are listing it. But this is what we are supposed to what we are making provision for. So at the end of the day, this is what we are getting here, right? So this is also correct. 15,100 is also correct. So that's what we will send to our statement of financial position. Okay, and this one will go to our profit or loss account as our tax expense for the period, right? Then we have to get our closing deferred tax. That will go to what? To the statement of financial position as well. So closing deferred tax. Closing deferred tax. So mind you, we have opening deferred tax and we have deferred tax for the period. So what we are supposed to do is just take the two. What is our opening deferred tax? We take the opening deferred tax over here. The opening deferred tax from the trial balance of 21,000. And then we add our deferred tax for the period. So these two will give us the closing deferred tax, which we will send to our statement of profits, the balance sheet, the statement of financial position, right? So the summation, if you look at the formulas we used here, the summation to get the closing deferred tax is the deferred tax for the period plus the opening deferred tax. This gives us the closing deferred tax in case we are given. So you can see we sum up the opening and then what the deferred tax for the period to give us the closing. So we have seen all the presentations. Okay, increment in deferred tax is what we treat. So if you compute for deferred tax and you get 100 over here, and the next year on the same asset you get 120 here, this is the closing. This is actually the closing deferred tax. So the difference between these two figures is what you treat in the pure L. So the 20, the increment, is what it will be the deferred tax for the period. If let's say we come here and it's 200, is the increment. If it reduces, then it becomes an asset. Okay, so let's say in the next year it's reducing to 140. The difference of 60 becomes what? An asset. So with the increment that we treat in the profit or loss, that is deferred tax. And then the end of it is what? Is the closing. Please, these are the principles and then the concept of deferred tax principle or deferred tax assets. Sorry, the income tax, IAS 12, income tax. These are all the principles and then the concept we need to know under IAS 12. What is left for you is to solve more questions. If you have any issue, you can put it on the page, then we deal with it. Any question? Any confusion before we go? All other questions follow similar approach, and if you apply this approach, you should be able to, get it right. Any confusion? Any question? Alright, silence means consent. On this note, we will end today's tutorial here, and we will continue again next week at the same time. Please, I've posted some survey on the page just to improve on the time. Some people were complaining of the time. So if you have any concern, the questionnaire is on the page. Please just click. It's just 1 minute. I think it's just something just to know the time that will be favorable for all of us. Then we can have this done at our convenience, not to inconvenience anybody. All right, please do have a great day, and thanks.